All right. Thank you very much for everybody that has logged in. We're going to go ahead and get started in just a minute. Got my colleague and friend Kevin with me today. We're going to talk all mortgage fund today. So give us a minute. Let some people log in, and we'll be back in just a minute. Kind of a side discussion, Kevin. Are you watching that 10-year treasury right now? Seems to be the talk of the
We
town.
started, yeah. I mean, that's the big stress point for the institutional guys, right? They've been warning, like they said it up publicly, so I can talk about it. They all made the comment: if Treasury hit 5, we're in trouble. I'm like, yeah, yeah, you're obviously in trouble. And if you're doing a lot of, if you're like, heavy DSCR, you're in absolute trouble. So, it's gonna affect the DSCR guys more than anything else. It's,
Yeah, no, I
but
agree.
and also the aggregators, they're gonna be out. It's gonna have them in a tough spot for a while. So.
Yeah, all that 30-year, that kind of more conventional 30-year debt is.
Yeah, I mean, listen, it's a good model even for bridge lenders to have as an outsourced solution, but it's still, that for California, it's never been that popular of an asset class. Outside of California, there's some markets there it's immensely popular, but
Yep.
it becomes very untenable to fund when treasuries are at 5.5, and we're creeping. Well, it looks like it's creeping above 5 now. So, it's a very tough time to be in long-term paper right
Yeah,
now.
no, I
Yeah.
agree. I agree.
Yeah.
All right, so a couple minutes past 11. Let's go ahead and get started. We have a ton of content to talk about today. So this is one webinar, a part of webinars that I'm putting on, essentially an educational series of webinars that I'm bringing in industry experts to talk about the mortgage fund industry. The mortgage fund industry has exploded over the last couple of years for a number of reasons. One being that the rise in interest rates have made investments in a mortgage fund a lot more attractive. So today's discussion is going to be really targeted at investors that are thinking about investing in a fund or may already have invested in a fund but want to learn more. Also for mortgage professionals that might be considering establishing their own mortgage fund. So just a quick disclosure, this webinar is for educational purposes only. It does not constitute an offer to sell nor a solicitation to offer to buy any security. Such offers can only be made through a private placement memorandum and related subscription documents. If you're considering an investment in a mortgage fund, highly recommend that you speak with your financial advisor, attorney, CPA, or other professional before making an investment. So let's go ahead and get started. I want to introduce a friend, a colleague, Kevin Kim. Kevin is a partner at Fotra Law Firm. He handles their corporate and securities practice. He's handled the formation, I imagine, Kevin, of hundreds of mortgage funds. I know you've been involved in secured debt offerings, real estate syndications, crowdfunding offerings, though I haven't seen a lot of crowdfunding offerings. Maybe you could shed some light on that for us today. Qualified opportunity funds. So as I mentioned, Kevin is a colleague and a friend of mine and actually helped us establish and set up our fund. Kevin, welcome. Thank you for coming on today.
Thanks for having me, Brock. Yeah, I mean, we do a lot of debt funds and private lending. So, bridge lending, both in residential and commercial. Probably, yeah. I mean, I think the count now, if you include revisions, are probably, pushing up on over 1,000 now.
Wow.
Jurassi's 16 years old this year, so been around some time now. And we're lucky enough to represent a lot of players in the space, including yourself, and consider a lot of our clients long-term allies and friends. And we're happy to kind of educate the investor community about this interesting asset class as a private investment. So happy to do it today.
So I want to make this a discussion. So this isn't just about Kevin and Brock talking back and forth. We asked all of our participants to ask questions because what we're going to talk about today gets pretty detailed and can get complicated. So if you have a question, feel free to use the Q&A button at the bottom of the screen. For others, I think others it's at the top. Go ahead and submit your question. I promise you other people probably have that same question. So questions are definitely welcome. So with that, let's go ahead and start with our first question. Kevin, can you talk about what is a mortgage fund? And what are people investing when they invest in a mortgage fund?
Yeah, good question. So I think we all know what a mortgage is, and the idea of what a fund is the kind of the operative issue. So a fund is essentially an LLC, LP, some kind of entity that pools a bunch of assets in one place and raises money for the purpose of acquiring or funding and holding those assets, right? So it can be real estate, it can be mortgage, it can be a number of things. In the context of mortgage funds, the idea is the fund is created as a means to fund the loans, to buy the loans, to hold the loans, and the investors acquire either membership interest or LP interest as an investor, and that membership interest is basically like stock, right? And the idea is you're owning a piece of the pool, and it spits off income, right? It spits off interest income, fee income, gain income from real estate, so on and so forth, and that produces the income distributed to the investors. And at the same time, because we're having a pool of assets, you have the peace of mind that you're not one-to-one, right? You're not dealing with individualized risk. You're dealing with a pool of risk, and that allows you to not only diversify your holdings in one single investment, but it also allows you to spread out risk. So one loan going bad isn't going to hurt you like it would if you were a direct investor, or what we call it a trusted investor here in California.
Yeah.
And the nice the nice part is that this gives the lending outfit a significant amount of flexibility in its operations, which is ultimately benefits the investor. So for example, it allows via the mortgage REIT strategy, it allows for yield enhancement and cash management via lines of credit. It also allows for the aggregation of sale loans to the institutional market that allows for yield enhancement for the investors and enhanced liquidity. So there's a lot of features you can do in a fund that you could not do if you were, for example, investing as a whole loan or fractional loan trusted investor, aka direct investor, right? And so that's the kind of the key thesis of what these debt funds are. From an investor's perspective, it kind of, I guess the corollary is in the public markets, you can correlate them to these mutual or ETF funds, but they're different in the context of these funds don't buy securities. You have non-correlated risk, so you're not buying publicly traded securities in this thing. You're holding a significant a portfolio full of basically short-term bridge loans on first position real estate, in most circumstances residential and small balance commercial. Very, very safe investment considering compared to the volatility you'll see on Wall Street, right? So it's a very, very not well-known asset class, but I think it's starting to become more popular because it's quite I guess they can call it lucrative. It's a very attractive investment if you really get into the nitty-gritty of it. So
true. You brought up a couple of points. So being a fund manager and also being on that trustee side, you make great points about diversification and whatnot. Now, you used some key terms. You used LP and GP. Can you explain the difference between what an LP and a GP is?
Yeah. So when I say LP, I'm talking about the fund investor, right? They're buying. Usually a fund is a structured as a limited partnership, right? Or a limited liability company. So the investor is either buying limited partnership interests, meaning that they're an LP, or they're buying membership interests, thereby becoming a member of the entity, right? And then the GP is the party that controls the limited partnership, which would be the principal, right? So Brock, your company would be considered the GP of your fund, right? If you were an LP, you're an LLC, so it's manager, right? So you're the manager of the LLC. Same concept. And we use the term LPGP more colloquially as well when we're talking about funds. It's because at the institutional level, you kind of refer to investors all as LPs, and you refer to the manager as a GP, even if it's not in a limited partnership structure. So
LP is the investor in the fund, and GP is a manager of the fund. They're the ones that are at the helm directing the fund.
Correct. And GP stands for general partner, right? So in a limited partnership arrangement, you have a limited partner who's someone who's usually more passive, an investor. The GP is the one that's the general partner. It's managing the operation, managing the day-to-day of the fund's business activities, and also raising the capital.
So as I mentioned before, when I first started in the business, we were offering one-off loans. Again, you mentioned like here in California, they're called trust deeds. In other states, I imagine you're investing in mortgages, kind of same concept there. This is different because now you're investing essentially in a basket, a bucket of loans. And so you're more diversified versus just being allocated to that one loan.
Correct. And that presents its own pros and cons, right? And I believe personally, as someone who's done this as a career, I'm biased. I'm a debt fund specialist, right? I've been doing debt funds for my entire career. But at the same time, I've also sat in the position as an investor. And if you put the investor hat on, to me, the pros outweigh the cons in the context of this. I, as a trusted investor, I am not in the weeds of being an underwriter and being an asset manager. I'm really relying on the originating party or the broker to do most of the legwork. And I'm really believing and trusting in him. That's the majority of the trusted investors out there. And so in that context, it's still kind of, I guess, passive, but the problem is the risk is being directly transferred to me. So when I mean risk, is like if I fund the trust deed, fractional or whole, my name or my company's name is on the deed, on the mortgage, on the trust deed, right? So if there's a problem and the borrower sues, the borrower is suing me. They're not suing you, they're suing me. And I didn't like that, right? So the second issue I had was, well, if this loan pays off early, my problem is also, well, I have to find a replacement investment to maintain my target yield. So if I've invested in a trust that's producing a 10% interest rate, great. But if it's a bridge loan, so it can get paid off early. If it gets paid off at, let's just say, month 6, and I don't find a replacement for the calendar year, I've only made 5. And I hate that. I have a target return of 10 for the year. So I would prefer to see the money moving at all times. The last part of this is also, I don't have the luxury of taking these trust deeds and enhancing the yield with financial engineering. And that may sound like a risk to a lot of clients, but I've worked with the credit facility companies out there, and I know this, it's not as risky as they think, but I would like to be able to get yield enhancement out of the asset, right? And that's a very important piece because, and it's easier to get yield enhancement if you lever a pool than if you lever a single asset, if you can get it. So all of those features told me, and the downside risk of, okay, listen, yeah, sure, I get direct control, but at the end of the day, I am not smart enough to be a loan servicing person or an asset manager, even though I live and breathe this stuff, right? I don't have the time.
Well, you don't have the time. Honestly, you probably don't have the time either.
Right. I don't have the time either. Exactly. I'm very busy. I work about a 50-hour week. I don't have the time and energy to deal with this stuff. So it does create this weird dynamic where I don't really want to be that involved, right? And so some clients tell me they love the idea of being in control. I always ask them another question, like, how much are you really in control? Because you've probably delegated a lot of that responsibility to the servicer, and they're getting compensated for it. So at the same time, you kind of refuted your own argument by looking at your servicing agreement, right? So I'm of the mind that the pros definitely outweigh the cons when it comes to debt funds, from those reasons. Beyond that, just from a yield maintenance standpoint, where else am I going to find the returns in the fixed income market like this? I just don't see where you can find it. So
I agree. When I sat down with you, when I first established the fund, I think one of my biggest concerns was, how am I going to move these trusted investors and get them invested in the fund? A lot of them didn't have a great, I guess, viewpoint on wanting to invest in a fund. And I know you had mentioned, Brock, most likely they're going to see the advantages and move. And that's exactly what happened. I would say probably 80% of the investors that I had in individual trustees saw the advantages and moved into the mortgage fund. And if you ask them today, I don't think many of them would ever go back to individual trustees.
Right. And I don't tell investors to pick one
Yeah.
or the other. I say do both, right? And I have a client. He's, I guess you can call him a lender. He's a lender. He's a trusted investor. He's a real estate investor. When I talk to him, I say, I don't listen out. Like, you should have some money in funds. You should have some money here. You should probably do a lot of things, right? You have the luxury of a large bucket of capital, so it's probably a good idea to do multiple things.
Mhm.
And and he's always been in funds, but he had been over allocated in trustees for a long time. And I told him, well, let's look at what your business is doing and where you want to go in your life as an operator. And lo and behold, that made his life a lot easier. And at the same time, I always tell trustee investors as well, like, the reality of the world, this business, the trustee model is falling out of fashion because there are so many incentives to do a fund, and there's so many disincentives to do trustees, because
Yeah.
trustees only work at the local level. It's very hard to scale that
Mhm.
beyond your local market. There are a few companies that have done it, granted, right? And I give them a lot of credit for doing it, but it's very, very hard to scale using trust deeds. It's just really inefficient for you as a business
Yeah.
operator. And
And Kevin, that
so,
you hit upon the point of exactly why we went to the mortgage fund structure.
right. I mean, it's as simple as this. Like, every deal, every loan you have to do, you got to herd cats to get that deal done.
Yep.
And then what happens if that one guy is on some island or on some golf course somewhere where you can't reach him, or is just dragging his feet on the wire authorization or whatever it is? It just becomes this really untenable
Yeah.
mess when you're doing more than a couple of deals a month. You did it for a long time, Brock, and kudos to you for pulling that off.
Yeah. Yeah.
I
Yeah,
don't
we
understand
got
how
to a point of where we were about 50 million, and I was about 300 plus investors. And from an efficiency standpoint, internally, it wasn't working. And then I wasn't really doing what I needed to do to help my investors as well. I wasn't able to place them in trust deeds when they paid off, and
right.
it was just a much smoother transition. But a question did come in, and this is a really important question. So some mortgage funds use no leverage, others just enough to smooth out cash flow. And that's why we use leverage as kind of more of a cash flow tool. Others use it to goose the returns up to 40% of fund values at times.
Yeah.
That's a lot. But
Uh,
how should investors assess how much is too much? And in reality,
yeah.
how much of a risk is there to the investor principal by using, by really levering up?
Yeah. I think there's a lot of myths around leverage right now.
Yeah.
And I think a lot of investors don't really understand what we mean by leverage. And their perception is based off of 2008 warehouse lines that were marked to market, and then they heard the word margin call and all that kind of stuff, right? They think of margin call. They may have seen the movie Margin Call. They have this really, really strange understanding. And if they have any understanding of the way these instruments work, they would realize there's very little risk to the investor, because the way these instruments work is there's a limited advance rate per loan, right, on the entire revolving line of credit. So,
Okay.
for example, if the bank says we're only going to advance 65, right, that means they're going to advance 65 on the loan amount. They're not going to advance 65 on the entire property value. And they're also going to make sure that there's a lot of, I guess you can call it, institutional underwriting standards installed and eligibility criteria for the underlying asset being pledged. And
Yeah.
even if that loan, and even if bank will be the first one to tell you, get these loans off the line, because they don't want to be in the business of calling lines, right? Now, this raises the question, not all lines are created equal, right? And there have been companies where lines have been called. There have been companies where problems have arisen because of lines of credit. And I always tell investors, when you're looking at a company, you have to really evaluate a fund. You have to really evaluate which institution they're borrowing from, right? And so there's a reputation out there, right? And so you want to make sure that institution is financially solvent, because we saw in banking crisis recently, it wasn't the fund that was the problem. It was actually the bank that was the problem.
And want Lehman Brothers being your credit line. Is that what you're saying?
Pretty much, right? And so there's also other features of lines that you can ask the sponsor about. So what I always tell investors to watch out for is, you may want to ask, is your leverage mark to market, right? And most of the bank warehouse lines in our industry are not mark to market. So that's a good thing. And what I mean by mark to market is that a mark to market provision means that the underlying assets being pledged to the line can be marked down based on market conditions, not based on book value, which is the true accounting methodology for valuing these loans. And so you run into this risk situation where if the market starts to take a dump, then the value of the collateral gets marked down, hence higher risk of being called, right? So that's another issue. I don't actually tell clients that there's a certain ratio. I will tell clients the overwhelming sentiment is to kind of stay under 1-to-1. There are a lot of investors that say, oh, we only want to see it for cash management. But I always ask them, and these are even institutional investors at the RIA level, I always ask them, do you understand how these facilities work? And they feign, knowledge. And when we get into the weeds of the actual widely used facilities out there, they're surprised. And so, I've been in calls with the banks on these situations, on the ones that are widely used in lines that are in jeopardy, and every single time we worked it out, right? Because all we have to do is move the collateral off the line, let the fund deal with the default. Bank lines no longer in jeopardy, and that's what you're worried about, right? So,
we use it for more cash management, as inflow and outflow of capital. But what I find is I have a great relationship with our capital partner, with our bank on the credit line. It almost acts like a third party, fourth party, let's call it, beyond just the investor, that really dives into the financials and structures of our fund. And does bring up some really, really good questions. I mean, the underwriting took time to get that credit line approved.
Banks are incredibly conservative, and they're not going to just lend.
Oh, especially today too.
Especially today. But at the same time, there are facilities out there that were really crafted for conventional or non-QM strategies where they're just supposed to be short term. And this is another question investors should ask. Are your lines like long-term committed warehouse lines, even if they're non-committed, like long-term warehouse lines, or are they short-term repo facilities that are intended for the loan to be sold off the fund's balance sheet quickly? Those repo facilities that are meant for short-term duration have an increased risk because their interest rate models go up after duration exceeds 30, 60, 90 days. And that creates risk to the investor. So,
and then you're really kind of getting into also to the fund. What is really the purpose of the fund? And is it one to hold to duration, or are we talking moving capital? And we could be here all day.
They're actually very lucrative in the right circumstances, right?
Yeah, it is.
In the right circumstances, they work. And so this is where investors need to get more education about. There are different types of funds that exist out there, right? There are long-term hold funds, there are true pure balance sheet funds, there are funds that are designed for short-term duration and sell off to the secondary. We call those gestational funds. There are funds that are meant for, effectively, they're going to be term paper, right? And they're going to be long-term paper, right? 10-year notes, right? So everything is different out there, and it's important that investors educate themselves. And the nice part is I always tell them, you can call us at any time. I'm happy to explain these to you, right?
So kind of in layman's terms, what Kevin is talking about is there are funds that specialize in just holding debt through duration. So I fund the loan, that's how our fund works, and I'm going to hold that loan until the loan pays off. But there's other funds that will actually churn loans. So they fund it on the balance sheet, may sit there for a couple of days and then sell it off. They earn income from the spread between what they had originally, there's a bunch of fee structures, but essentially what they charge the borrower and then what they're selling that loan off. And then they can aggregate those fees. And it becomes pretty lucrative if you can run enough loans through that model.
There's a time and a place for that too, right? And right now is tougher times for those folks, unless they're kind of, market dominant performers. At the same time, funds that are balance sheeting are producing significantly better returns just by virtue of the market going up, right? So, I there's a time and a place for both, and I always tell investors it's okay to do both, right? It's okay to invest in both. So,
well, we may have a follow-up webinar on just that, Kevin.
Yeah, absolutely.
So let's talk about security. Look, big question I get from trusted investors. Again, you kind of hit upon this. just briefly explain what is your security when you invest in a mortgage fund?
Good question. So there's a lot of misunderstandings about this out in the market. So debt funds are a equity investment. So that means you're buying ownership interest in a pool of mortgages, right?
Mhm.
So that means that you are buying, like I said earlier, stock or the equivalent of stock, right? You're buying membership interest, limited partnership interest in this entity that owns this pool of mortgages and is being managed by a sponsor like yourself, right?
Mhm.
And that means you're the owner, right? And equity, technically speaking, is on the bottom of the capital stack in the sense that if you were levered, they are senior to your equity position. So from a collateral standpoint, you don't have collateral, you have ownership. Okay, that's the
Mhm.
key issue, first of all. If you want collateral, that's more on the line of a debt structure. There are debt offerings out there that are note-based investments or trusted investments. Then you have collateral, right?
Mhm.
This is an ownership interest in a pool of loans. And by virtue of that, you get the benefits of diversification. You get the benefits of, you can call it insulation from risk because you've got a pool of assets opposed to one asset. And you also have the benefit of all the other features that we talked about. You can sell loans for liquidity's sake, and you have your money working year round. So there's a lot of that benefit. But the key issue here is that it's an ownership interest. So, much like any other fund out there on the real estate side or the mortgage side, you're buying an ownership stake in this company.
So a question comes in. What risk is there to investors' capital in the fund? How do investors lose money in these
Yeah, good
funds?
question. Yeah. So we started in private lending during the recession, and the funds that lost money were the funds that the investors bullied the sponsor and in the
Yeah.
most predatory way possible. And the sponsor had no choice but to liquidate. And this is also during the recession, mind you, right? So this is like during the worst of times. The sponsor was forced to liquidate the portfolio at a discount
Mhm.
because of all the pressure
All
and
the redemptions that were coming in.
all the litigation being
Okay.
threatened and filed against the sponsor for liquidity. Right. And they didn't have the right mechanics in place to prevent that. And so that's the one thing is like you can call it irrational mob mindset when it comes to
Yeah.
investors. Investors need to educate themselves. Investors also need to give the sponsor the benefit of the doubt. A lot of times their brain immediately goes to, oh, he's committing fraud. Probably not. It's
So
very hard.
essentially what you're saying is a run on the bank, a run on the
Yeah.
fund.
Those are the situations where we see the significant losses because the manager's forced to liquidate the assets at a fire sale, right?
Okay.
The other times we see funds lose. When I say lose money, in the past about 10 years, the funds that have realized losses. So the capital accounts of the investors have felt a small loss to their capital account, right? So small devaluation
Yeah.
is from portfolios that incur too much risk in the world of either too much long-term financing or subordinate financing, or basically just too much risk on the books,
Mhm.
and that primarily came from preferred equity, mezz debt that was just too much risk,
Yeah.
and mostly on the commercial real estate side.
So when you say preferred mezz debt, you're talking second position debt. So
Junior debt,
their
yeah,
strategy
it's
was
junior
to
debt. Yeah,
invest in second
it's
position.
junior
Yeah.
debt. It's on an asset class and it's also too long on a project that probably the fund should not have
Mhm.
been pursuing. So it's important from an investor perspective to understand what the tape looks like, right? What's your
Yeah.
composition right now, right? And it's a fair question to ask. And every sponsor should be able to actually
Absolutely.
give
Yeah.
ratios. Hey, we're 80% in resi, 20% in commercial,
What
99.9%
position are you in?
first. Yeah,
LTV. Yeah.
exactly. What's your average LTV? How much is in construction debt? What's your delinquency rate? What's your default rate? Those should all be open kimono questions, right?
Yep.
And in the past 10 years, the number one reason why funds lost money was not because of leverage, was not because of that. It was really primarily because of the fund took on unnecessary risk in pursuing opportunistic strategies without
Yeah.
adequate I guess you can call it structuring to account for it. Beyond that, I mean, absent, I'm talking about situations absent fraud, mind you, right? So there have been instances in the space where fraud was committed, and there are bad actors out there, but it's not really worth discussing because you can't. There's always going to be evil in the world, right?
Mhm.
But in most instances, there have been significant levels of insulation because even with leverage, right, you're able to recapitalize pretty quickly. You're able to play capital preservation pretty quickly if you have the necessary protections in place. Now, investors see that and they're like, "Oh, you're restricting us." My
No,
mind goes,
I see it the other way around. No, I'm protecting you. I'm not restricting you from taking your money out. We're protecting
exactly.
you from a run on the fund. I agree, and that's a common question or comment, I guess, I would get about lockup periods in a fund.
Yeah, and investors get stressed out about the idea of liquidity, but I always tell them like these are not liquid assets.
Yeah,
And you should understand that. If you want liquid assets, go invest in a correlated asset on Wall Street. These
yeah.
are illiquid assets. They're private. The sponsor needs time to properly let these mature or liquidate in due course so that you don't lose money. And that's important. And once the investor understands that, they get on board, right? And
Mhm.
that's the difference maker, right? So I always tell clients when the tough times come, like COVID was a good example. When tough times come, it's really on you to make sure that you're communicating like crazy to your investors
Mhm.
and really up the level of transparency and communication, because the highest likelihood of investor frustration comes from a lack of communication to them. They feel left in the dark. And
Mhm.
so that's where I feel like, problems arise with debt funds. It's usually your average debt fund that's doing kind of what you're doing, Brock, you're a first position trustee,
Yeah,
bridge lending. They very rarely lose money. So,
yeah. All right, so we're going to move on. There are a couple questions, but we're going to hit upon some of these questions regarding investing in retirement funds, and
oh,
then
yeah.
what they should look for in a sponsor. We're gonna get to those in just a minute. But another thing that I wanted to hit upon is the types of mortgage funds. So
Mm,
we're a 506c fund. We go through an accreditation process. 100% of our investors need to be fully accredited. For those
yeah.
that are not familiar with the term accredited, that's a net worth of $1 million or greater, and there's some income restrictions as well, requirements. So, Kevin, can you briefly talk about the types of funds out there, why some people have to be accredited, some people don't?
Yeah. So the reason why the vast majority of debt funds are using Reg D, 506B or C, is their exemptions to registration, right? And when I say registration, that's being publicly registered with the SEC, listed on some type of exchange, right? OTC, NASDAQ, NYSE, whatever, right? And in that circumstance, you are now publicly registered, and now you have share valuation impacted by public sentiment. These are privately offered securities exempt from registration, and the government has said that we're okay granting an exemption from registration provided that the investors are all accredited investors, right? And there are other requirements, but the biggest hangup is accredited investors, right?
Mhm.
And makes sense, right? The SEC's logic has been that high net worth investors, aka accredited investors, and above that, are wealthy enough to absorb risk, and they're sophisticated enough to select their own investments at their own risk. We don't effectively we don't care as much about them as your average consumer who might lose their shirt on in an investment because they're unsophisticated. So that's the logic behind the regulations. As
Mhm.
it pertains to kind of from a practicality standpoint, it makes a ton of sense to stay exempt. You don't want to go register because the costs go through the roof, and I've yet to see a debt fund go register publicly and do well. There was an attempt a couple of years ago. I think they're still around, and they've suffered for it. There are only a handful of outfits that have handled it well, and the vast majority of folks that stay private. And it's a good thing for investors because it reduces your cost load, but also you don't want to be in a correlated asset, right? You don't want to be in an investment that's subject to market conditions. All of a sudden, your stock values went down because whatever the market thinks about mortgages, right? So you're just going off of value of the actual mortgage itself. It's a good thing. Beyond that, I also tell investors you kind of want to be, well, don't you kind of want to be in a pool of other high net worth investors? Because it protects the fund very pragmatically, right? An accredited investor is less likely to have sophistication issues, less likely to be an activist because they understand the asset class, they understand it's an illiquid investment. Whereas a non-accredited investor, to me, in these debt funds especially, they're kind of a liability, right? Because, and it's not their fault. It's a, $20,000, $30,000, $50,000, which are common minimum investment amounts. It's a lot of money for a non-accredited investor.
Yeah.
And even if they are sophisticated, it's very stressful for them. And so it makes more sense for these investments to be catered towards high net worth investors. And that's the same truth with real estate offerings too, right? Which is why you see the vast majority of folks in that sector also use Reg D. So that's kind of the logic. I always tell sponsors too, like, you may have this grand vision of going public. I would want you to think twice about it. The amount of reporting and cost and market condition sentiment that you have to deal with, it's really not worth it. And I think the the theory has been proven. If you look at some of these companies, like, one example is Broadmark. They're more on the commercial side.
Yeah.
And I don't know. I mean, their competitors are outperforming them, and they're staying private. So,
All right. So question came in. Why are some funds registered with SEC and others are not? I think you somewhat touched upon that. Most private funds are not going to be registered. I mean, they're registered with the SEC through the
I mean,
Reg D.
even the institutional ones, guys. Like, I think the market is understanding staying private gives you a lot of benefits.
Yeah.
Because once you're publicly registered, that's a lot of reporting, and also your value is dictated by the market, right? So,
So the value, your share value within that fund starts to go up and down.
Yeah.
Fund
because
where a dollar is a
likely
dollar
going to have
unless
to be
there's
on some kind of
realized
exchange,
losses.
and that exchange will dictate the value of your fund units, right? So I would to that question, my answer would be the vast majority, 99.9% of debt funds in private lending are private. Even the biggest one, like the biggest one that I'm aware of, is a little bit over $2 billion. That's non-institutional. They're still privately offered under a Reg D. There are also institutional Reg D funds too. Like recently, KKR and BlackRock each independently set up credit funds. Those are Reg D funds, right?
Oh, interesting. Okay.
Yeah, they're no different than. I mean, they're much more fancy, right? They have all these bells and whistles and different features, but at the end of the day, they're Reg D funds. So there's a beauty to being exempt from registration.
Okay. One quick question here. Can you comment on the current legislation in Congress that allows accreditation by test? So I guess, is there any legislation that is moving the accreditation process?
Okay, so I think he's referring to, there's been two initiatives on this issue, and I don't think that's going to get passed, not under this administration. It presents too low a standard for this current SEC to get behind. If anything, if they had their way, they probably increase the limit. And I can't really understand why, because they recently just did this a year ago or 2 years ago. So they had an opportunity to increase it and they didn't. And they just added a certain features to it. So I don't know where it's headed. I don't think it's gonna be reality anytime soon. Also, you got to think next year's a lame duck year. So they're gonna be the SEC is gonna try to push through some rulemaking next year at the last minute. We'll see how that goes. I'm not entirely sold on this actually going through. So
okay. There's a couple of questions regarding our fund. I'd be more than happy to share any information on our fund on the side. So yeah, you can email me and I'll share any information on our fund. Another question. This is an interesting question, and I get this a little. Does the typical investor reporting, so this is the reporting that a GP or fund manager may send out, does it list all of the loan assets in the report? And you may not be able to answer this question, but with its actual valuation of that loan.
Question. Well, I mean, you could do that. There's no rule saying you don't have to. You shouldn't do it, though. An investor, you probably don't want that, because the average, I guess you can call it private lending debt fund, the average loan size is probably around, I mean, California's a little bigger, probably $500,000 and up. but
Yep.
the average loan size is probably pretty small, and which means you've got a laundry list of loans, right? And I have a client who's kind of smack dab in the middle in size. They're a little bit over $150 million. They've been doing this for about 10 years. If they delivered their tape to their investors, it would be like just this massive Excel spreadsheet that you would not want to read, I guess. And also, is it material? It's not. They have no obligation to either. So what we tell clients from an investor reporting standpoint is that you do have an obligation to report. You should be disclosing key performance metrics of the portfolio. So concentration in geography, concentration in first lien versus junior lien, concentration in resi versus commercial, in bridge versus construction. You should be disclosing that kind of stuff. If the investor has a deep-seated need to get deeper than that, sponsors have kind of gone deeper with the client and provided the information, and that's a matter of transparency. But I'm not a believer in literally disclosing the entire tape, because I think it's just too much information to parse and creates a lot of risk for the sponsor, because you have an obligation to protect your borrower confidentiality too. So you want to be balancing that risk as well. So
I think it's a common question we get, and if some investors want to like really dive deep into it, we'll talk them through and understand why.
Yeah, I'm all
it brings
for
up a lot.
reporting. I'm not a big fan of disclosing the entire tape. I think it just creates a lot of resource strain on everybody. So
okay. So let's go on to the next question. We talked about kind of why accredited, non-accredited investors. Let's jump into REITs. Okay. A lot of mortgage funds over the last, I would say, 3, 4, 5 years have decided to either be structured out of the gate as a REIT, and that's a real estate investment trust, or have essentially added a REIT component to the fund. Can you explain what a mortgage REIT is and some of the advantages of why an investor might want to invest in a mortgage fund structured as a REIT?
Good question. Yeah. So a REIT REIT's an abbreviation, stands for Real Estate Investment Trust. And there's this kind of myth that, you have to be publicly registered to be a REIT. You don't have to. Privately traded REITs exist, and I do a lot of them. So, and I structured Brock's REIT, right? So there's a lot of a REIT. All it is it's a fund that has some tax features to it that create tax efficiency for the investors. That's really all it is, right? And there are all these requirements for a sponsor to follow and meet on the qualification side, and those are pretty significant lift, and they're important to qualify for these tax benefits. From the investor's perspective, you're thinking of this as a tax enhancement, right? It improves tax efficiency for the investor. Now, for debt funds particularly, let's talk about the primary benefits. Number one, until the Tax Cut and Jobs Act expires or gets killed and not renewed, it allows for a 20% pass-through deduction to the investor, regardless of tax bracket. And so, because it's a qualifying REIT dividend. And so that's beneficial for the investor. So the simple math, you're going to get, if you have $100,000 distribution, you're paying taxes on 80 of it, which is great. Right?
And I would say that's probably the top 3 reasons why I think investors really do it. From my standpoint,
they love that, right? Because the downside of these debt funds is you're dealing with ordinary income, right? Which is why it's also very popular for plan asset investors like self-directed IRAs to invest. But at the same time, there are other benefits that are really material too. So I mentioned IRA investors. Well, REITs also block unrelated business taxable income. And that's very material in the context
This is important. Listen carefully. This is really important. If you are using an IRA to invest in a fund, in any fund, this is important. Listen.
Right. So if you're an IRA and you're investing in a fund and that fund is leverage, that will generate what's called unrelated business taxable income. Now, it's not taxed immediately, right? The IRA has to pay tax after the first $1,000. I don't know the tax rate off the top of my head, but if you're an IRA investor, you're kind of expecting no taxes on your investment, right? And so it sucks. It hurts your feelings as an IRA investor. And so REITs block that entirely, which is a very material thing for the IRA investor. But it also is very material for the sponsor because it opens up the opportunities of other investors that are tax deferred. So charitable remainder trusts, endowments, small pensions, it's material to them, and also family offices. So this is very material to them. So it blocks it altogether. So it's a very, very popular strategy for debt fund managers because leverage is almost an absolute must to manage cash. IRA investors love the investment strategy. So you got to marry the two together. This will block that altogether. And it's actually been the number one reason why clients are thinking about keeping their REITs, even after the 2025 sunset of the Tax Cut and Jobs Act. An additional nice piece, and this helps investors, it also helps sponsors, is it blocks state withholding and state returns. So if you have an investor that lives in New York, right? New York has their own tax, right? Income tax. You as a sponsor have to do withholding to deal with that income tax. And you have to file in that state a tax return if you're lending in that state. And so these issues are problematic for sponsors who grow and grow and grow and have investors all over the country, have loans all over the country. It can be a big administrative nightmare. And for the investor, it also sucks because they'd rather file their own return, not deal with the withholding. So it makes life a lot easier for the investor and also for the sponsor by blocking the need to do a state withholding for the investor side and the state return for the lending side. So it becomes massively efficient, especially if you're scaling to multiple states, right? And you're doing loans in a number more than one or two states. It becomes a serious lift to do tax returns. So that's a huge load off their minds,
So did you want to put down a wager if that Jobs and Act is
it's
pushed?
tough, man. It's tough. It's a coin flip right now. My gut tells me no matter who wins the election, no matter which way Congress goes, Congress is really bad at doing things, right? And so the likelihood is they just punt things, right? They like to kick the can. So, I was witness to that when it came to EB-5. I was doing a lot of that kind of work, right? And they love to kick the can, right? Not my problem. Let future us deal with that in the future. I think it's a kind of a coin flip that they're going to do that. If the election goes to the Republicans, I think it's likely it's going to get it maybe extended or permanent because that party prefers tax deductions, and it was introduced by them too. So I think it's a higher likelihood. But even then, with all the things that are going on in the world, it's just hard to know where they're going to do, how effective they're going to be in actually making decisions. And we won't even know about it until some omnibus spending bill comes out and we figure it out, right? So, I'm of the mind that, think of it as a coin flip. Think of it as whether, think of it as an unlikely extension. And if it comes, great, right? But at the same time, if you're already set up for it and you have all the features, the UBTI blocking on its own is pretty
maybe worth just keeping it.
I think so.
Okay. All right. We're going to skip ahead here. I mean, we could talk hours here, Kevin, on just even high level fund information. So, question came up here: if you were to invest in a fund, what would be the top 3 things that you would look for before you invested? What are you looking for if you were to put your investor cap on right now and say, this is what I'm looking for?
Yeah. So my personal key metrics are track record. And I don't necessarily just mean the fund's track record, right? I'm actually looking at the sponsor's track record. Like how much volume have they produced in loan origination, right? Because it's a funny thing. You could be really good at raising money and you could be a terrible lender, right? So what's their track record when it comes to loan origination? What's their track record in loan servicing, aka asset management, right?
Which I tell investors, that's 50% of the business right there. You can
more than that. Way more. Because if you can't manage your borrowers, you can't manage collateral, you're not a lender. Beyond that, I look for, and this is a personal requirement for me, and I think it's a good idea to do, audited financials, right? I think it's a must-have. There's a reason why investment advisors insist on it. There's a reason why institutional investors insist on it. I think it's a must-have. I know it sucks. It costs a lot of money, but it's worth it. The REIT thing is kind of a hit or miss for me. I don't really absolutely must have, must not have. I understand the tax issues associated with that, and I have my own tax planning for that if I need to get some tax discounts, right? So I'm okay with that. beyond that, I would say, you really got to look at the I guess the summarize report on the portfolio,
Yeah.
and look at their default rate, right? And how that, and ask them like, hey, in the past 3 years, you can ask the sponsor, in the past 3 years, have you had any foreclosures where you lost money, right? It's okay to tell me. I'm not going to say no to you. I just want to know how you handled it, right? That's where I'm like, especially if I'm looking at a newer manager, I'm going to ask that question because I want to evaluate what their asset management skills are.
Mhm.
And then I guess the last piece for me is I prefer funds that are more concentrated in the sense that they have a very specific mandate, right?
Okay.
They don't go out to market saying we're going to lend nationally and
Yeah.
we're going to do commercial bridge and construction and fix and flip and real estate investing. I don't like that. I prefer to have a little more narrow of a mandate. And so, I write funds pretty broadly for clients on purpose, but the mandate is really dictated by the sponsor. And I
Mhm.
prefer clients who kind of concentrate on, a handful of loan types in a handful of markets
Yeah.
that they know they can dominate.
Yeah,
Right.
as a fund manager, I would agree with you. I think it's difficult to be able to take that shotgun approach and be lending in Florida while you're also in Washington and Arizona because private lending is such a localized business. It's
Yeah.
you need to know your borrower, you need to know your market, and you need to know your property. And I don't know how it's very difficult. I mean, there's definitely great fund managers that are doing it and some great
Well, if you
funds
look
out
at
there
the
that do it.
actual vast majority of debt fund managers out there that are successful, they're all regional, right?
Yeah,
They're local / regional, right? And so they're
yeah,
kind of in 3 or 4 or 5 states, maybe 6 states, and that's okay to me. And
yeah.
if you're going to be national, I think to be truly national in our space, you have to be institutionally backed.
Yeah, I'd
That's the
agree.
only way to do it because the load on your operation is just immense, right? So,
Mhm.
and also you need this industry. You can't speculate on a loan in Florida if you're in California. You just can't. You
Yeah,
need to
I'd
go and
agree
see
with
the
you.
product. You need to go. You need someone there. You need to understand the local market. It requires a significant amount of institutionality, which is a large load, which is why I think that the only way to make it work is if you're like I mean, shout out to RSCN, they make it work, right? But they've got a lot of institutional backing, so that works, right? So shout out to Renova, they do the same thing.
Yeah.
They're bigger, they're institutionally backed, right? And so that works. If you're a debt fund, I think it's smarter to be regional, if not local, and that's what and the market right now, those folks are all killing it. They're
Mhm.
doing so well because there's so much displacement, and they've always been there.
It's
And
market. I find it market penetration. I mean,
oh, for
we're
sure,
primarily in San Diego just alone, and I think if you talk to other fund managers, sometimes they kind of look at you and go, "You're only in San Diego." I mean, is there really enough business? And the answer is yes. I mean, if you
yeah,
can really select, here in Southern California, I mean, you can imagine how big the market is for just San Diego, Orange County, and Los Angeles. I mean, there's
yeah,
billion-dollar funds that are just localized literally in LA.
yeah.
So,
Yeah, and
um,
there's a scarcity mindset in our sector, and I think that needs to go, because
yeah.
if you have a scarcity mindset, you're always going to be trying to win on price or on something that's some kind of tangible thing
Leverage.
that you
Yeah.
leverage. You're going to try to win on things that you're going to get your ass kicked on once you start competing against the national shops.
All
It's
right.
just the reality
All
of
right.
life.
So we're coming up. We're coming up to the end of this. We're going to go through some lightning questions here. Can
Do it.
IRA accounts or other retirement accounts invest in these private funds?
Yes, they can, and they should.
Absolutely. Next question. As a debt fund investor, I'd be looking for a sponsor that has money invested in the fund.
Uh-huh.
How much should they have in the fund?
It's not a question of how much. It's a question of how it's not a question of how much, actually. It's a question of have they actually invested, right? It's not a question of how much. I mean, there's not every sponsor has the liquidity to do it, right? It's a question of have they,
Yeah.
and is it meaningful enough to you, right? Every investor is going to be different on this perspective, right?
Mhm.
I find it meaningful to have something in, because at the end of the day, losing money is important, right? So the fact that they're going to lose money regardless. some clients, some investors have told me they want to see a big stake. I'm like, this sponsor doesn't have that kind of money.
Yeah.
Right. It doesn't make any sense to insist on that.
Is it
So
is it big enough to be a pain, to be a pain point to them in terms of they're
yeah,
aligned, their
that's what I would
interests are
say.
aligned with yours.
Exactly. And then
Yeah.
beyond that, it's just a question of like, do you get the sense that this co-investment shows you that that they believe in their product?
Yeah.
That's what matters, right? So
Good answer. Okay, next question. Some investors won't invest in funds in judicial foreclosure states. Is that a valid objection or another overemphasized criteria?
I think it's short-sighted. The nice, if you talk to the local guys in the
Give
worst
us an
states.
example. Like, what state would you say would be one state that people are just really hesitant to?
Well, out where we are, everyone thinks that like New England is bad news bears when it comes to foreclosure, and nothing can be further from
Yeah.
the truth. You can actually foreclose faster in Massachusetts than you can in California for our asset class. So, if anything, actually, California can be worse than a lot of the judicial states, because you got to think, people don't understand the idea of asset management, right? When you're in a state that's primarily judicial foreclosure, once default hits, you're moving as fast as possible to find another solution than foreclosure, right? Which means liquidity, sale of a loan, negotiate a deed in lieu, whatever it is, you're moving as fast as humanly possible because you're not incentivized to foreclose. So there's that issue, right? And you should ask the sponsor. What's important is what the velocity looks like, right? How fast are you out of your problem loans?
Yeah.
And that's also why on the East Coast you tend to see a lot more clients sell paper, right? Or at the same time, figure out ways to mitigate their risk on foreclosure. So it's important to think through that. But I think it's short-sighted because you get, diversification geographically is important too, right?
So
And
it's not as big of an issue for you. You're looking at more of getting the ability to be lending in those states where there could be more
100%,
more
and
opportunity, diversification.
frankly, the yields out there are better, right? So
Okay.
why wouldn't you? It's that problem is on the sponsor, right? And yeah, sure, you could have some detrimental effects on liquidity, but then you can ask the question to the sponsor, hey, what is your usual time frame to liquidity look like?
Yeah.
And ask them an honest question. And if you get some kind of canned salesy answer, dig deeper, or if they don't want to give it to you, then move on, so.
All right, one last question. We're really wrapping up here, and I'm going to give Kevin a moment to talk about Gerasi and what he does. What are typical fund level fees in terms of asset management and whatnot? What are there industry kind of standards? I imagine, loan servicing fees versus asset management fees versus other fees in a fund.
Yeah, I mean, the vast majority of clients still charge an asset management fee. It's usually, I would say 1% to 2% on assets under management. There's some kind of carry on the back end usually. So, after some kind of participation on the back end. And then the biggest thing is more allocation of loan related fees, right? So you've got, origination and pre and post close fees. We're of the mind that we want our clients to succeed based off of the feedback given to us by investors. So we always advise clients there should be some allocation of points if you can do it, or at least net origination or a piece of it, because that aligns interest with the investors. Pre and post close fees is kind of a coin flip, depending on the sponsor, and those are not as material. So that's kind of the usual arrangement. We don't see a lot of separate asset management and servicing anymore because it's effectively the same thing.
Yeah,
so
I agree with you.
You unify those two together.
Okay.
And yeah, I mean, the goal is always, to try to be as profitable as possible to maximize returns, but also the sponsor needs to be making money to be incentivized to service the fund. So I think that's where we land these days.
Well, great. Well, Kevin, I want to say, number one, thank you very much for coming on today. You have so much information, and to try to put it together in just 60 minutes doesn't do this justice. So I wanted to say thank you very much for coming on and educating everybody here today. I'm going to give the stage over to you for a minute. Can you just talk a little about Gerasi, what it is that you specialize on, and why people may want to communicate with you?
Yeah, so I'm a partner here at Gerasi. Run the firm's corporate and securities division. Gerasi is the nation's largest law firm dedicated exclusively to private lending. When I say private lending, I mean business purpose loans secured by residential real estate, so real estate investments in residential real estate, or commercial real estate. So we represent lenders on both sides of the business. We represent lenders of all shapes and sizes. We're not just, we don't just represent debt funds. We represent brokers, new market entries, the institutional guys. We represent everybody. And our claim to fame is we try to be a one-stop shop for private lending business. We also have a significant grasp on the market because of our client base. And so you can get more of that, I guess, intel from us at our conferences. We hold 2 conferences every year. They both just passed. We hold one in every April here in Newport Beach, and then one every summer in Las Vegas. They're called Innovate and Captivate. We host those conferences ourselves. They're very
I would
valuable.
highly recommend, if you have an opportunity to attend one or both those events, they're probably one of the best that I've been to. I highly, highly recommend going to those 2 events.
Well, thanks for that. Ruby works very hard on putting on that show, on the shows. On top of that, we do a ton of content. So I always encourage people, if you want more market intel on the private lending industry,
Yeah,
I host a podcast, Lender Lounge with Kevin Kim. You can go on our YouTube page or our website. We have a newsletter. We have a bunch of content we do. I think my partner Nima does once every month with the AAPL on market conditions. So we do a bunch of content about this industry. And so you can go on our website to find out more, DrasilawFirm.com. Pretty straightforward stuff. And look out for our content, newsletters, videos, webinars, podcasts. And our goal is to be able to disseminate as much intel to the community as possible, and also gain brand dominance in doing so. I mean, selfishly. So,
and how can everyone get a hold of you?
Yeah, best way to reach me is either by email, k.kim@drasilllp.com, or go on our website, drasilawfirm.com. You can find me on there, both our podcasts and everything else, and learn more about the firm that way. So,
right. Kevin, thanks again for coming on. For those that may have come on a little late, we're going to go ahead and post this onto the TaliMar Financial YouTube channel. We post a ton of great content on the channel. Interviews like this with Kevin and other industry experts you can find on our channel. If you have any questions about what we talked about, please reach out to Kevin. He's just breadth of knowledge on this stuff, or feel free to reach out to me. Best way to reach me is at my email, bvandenberg@talimarfinancial.com. You can find all this information when we post this on the channel. So thanks again for tuning in, and I'll see you next time on the next webinar. Thank you.